If you've taken an Uber or Lyft recently, have you noticed anything different?
Prices. Jim, and I mean, we've all experienced this lately. There seems to be a bit of a shortage of drivers.
Right.
And the prices are exorbitant.
The cost of a ride from a ride-sharing app like Uber or Lyft increased 92% between January of 2018 and July of 2021. Many riders also noticed increased wait times for rides. So what's behind this change?
To us, the big issue is just that the driver supply remains fairly constrained.
In early July 2021, Uber and Lyft drivers were about 40% below capacity. The companies have taken notice and are investing millions worth of bonuses and base rates to convince drivers to return.
While the companies have been spending a ton of money to incentivize drivers to get back on the platform, you talk to a lot of drivers that say it's not really trickling through.
Uber is still considered an unprofitable company, and Lyft just recently reached the status of profitable when considering its adjusted EBITDA. Profitability was a problem for these companies even before the pandemic, calling into question the effectiveness of their business models.
It's hard to see how these companies become profitable, but the CEOs have promised that they would reach that measure, adjusted EBITDA profitability, within the next few quarters, and Lyft actually did achieve that. The question is if they can sustain it.
To turn things around, these ride-sharing companies might need to do even more to convince drivers to return.
I would say the companies don't really look at us as human beings, and they just consider us profit.
The pandemic hit almost every industry hard. Uber and Lyft were no exception to that. Ben Valdez, a driver and member of the group Rideshare Drivers United, remembers what it was like in the beginning of the pandemic.
Because everything was shutting down in the very beginning around March, the demand went down drastically. And I'm talking, I used to typically average anywhere between $100 and $150 a night. Once everything started to slow down, I was making, I think it was around $85 for 12 hours. So at that point, I said, you know what, I'm going to take a break. And a lot of other drivers took the same way out.
First, with rideshare, obviously, the decrease in mobility was a shock to a lot of the drivers that require this for their incomes, right? And it was airport rides, it was commutes to work, it was just general mobility. And so I think kind of the sudden drop off in demand, and then you add to that, right, that once demand started to build back, this idea that, was it safe for the drivers to be driving around passengers? I think there was an anxiety around that as well.
In fact, many drivers switched to food delivery.
I would drive like 150, 200 miles a day to make like 100, 120 bucks. And then I got turned on to Instacart and DoorDash and Amazon Flex. And I was driving like a quarter of the miles, and I was like making 200 bucks a day easy.
It was a bit like a gold rush for drivers who were not able to deliver passengers during the pandemic. While Uber's ride-sharing revenue decreased 43% between 2019 and 2020, its delivery revenue increased 179%.
There are investors and there are Wall Street analysts who have said that Lyft and Uber are, these great reopening plays, and that Uber is hedged because it now has this food delivery business plus ride sharing. So if the economy opens back up, it's well positioned. If we see the rise of the Delta variant, then its food delivery business would be well positioned.
We win both ways, and we stay relevant to the consumer, whether they want things delivered to their home or whether they want to go out, whether it's to a party or to a restaurant or to work.
Rideshare drivers are still the bread and butter for these companies. Uber may have seen a steep increase in delivery revenue in 2020, but mobility, the term Uber uses for its rideshare business, earned quite a bit more than its delivery business in the same year.
Uber said that it was spending, I believe, $200 million on driver incentives, and you really saw that hurt their core business in terms of that adjusted EBITDA profitability and their latest results. They lost far more money than Wall Street was expecting.
We're investing so that our consumer and our rider experience is better, and we can actually bring some of those rider prices down as supply shifts and balances out.
Uber's website says drivers make anywhere between $22 an hour in cities like Orlando to $37 an hour in cities like New York. Lyft has a long list of incentives and bonuses for drivers.
The minimum driver incomes was to us a very good barometer to try to understand, how aggressively they were trying to woo drivers back, right? And there's a host of other incentives that they use for drivers. They'll give a driver a bonus for running in a specific area. They'll call it a hot zone, right? They'll say you do an incremental ride, you give it extra bonus. But to us, the minimum income was a nice way to kind of encapsulate all of that was happening into one number.
But for those who are still making a living, or at least trying to, from ride-sharing platforms, the companies are not offering enough.
Look at how they treat us. Don't be scared, guys.
We pay your salary,
You know we're all drivers, right?
60 cents a mile driving around, it's not an adequate rate. At $1 to $1.50 per mile, I would say, people would be content.
There are some transparency issues as well in terms of how much drivers are actually earning and in which markets and where there is that imbalance.
It's hard to say exactly how much an Uber or Lyft driver makes, since the amount would be different depending on the location, ride frequency, and other factors. There is a base pay for drivers that differs from city to city. The full rate is calculated from the distance of the ride and the amount of time the ride took. Uber and Lyft both take their cut of this calculation. In the second quarter of 2021, Uber's take rate for rides was about 19%. But some drivers are saying that's not what they see.
So they started taking the bulk of the fare. And so that's how Lyft has now achieved profitability off the backs of the drivers.
Drivers do get to keep tips and bonuses, but to some drivers, the bonuses can feel too much like a game.
An example would be right now, during the peak hours, they are offering anywhere between $15 and $18 for every 3 rides that you take. The problem is because there's such a shortage on drivers, you now have to drive 20 minutes to go pick somebody up and potentially make $3 to $4. And so, a lot of these incentives are games, and they're just designed to keep people thinking that they're making money off of it.
The driver shortage calls into question the rideshare business model and whether it's a sustainable one.
A lot of these companies, the playbook was the same. Spend big, grow fast, pay people as little as you can, and expand your service, knock competitors out of the market, establish market dominance, and then raise your prices. And now we are seeing the last phase of that strategy.
And now those competitors, in many cases, they didn't make it.
New York City lost over 10,000 yellow cab drivers from January 2015 to January 2020 before the pandemic, when Uber and Lyft were both rapidly growing. Back then, rideshare companies were subsidizing the price of rides with promotions, discounts, and even just lowering the cost of rides to bring in new customers.
It was a heavily promotional environment, and part of that was to try to drive market share. It was to try to drive people to test, right, and to understand how these products work. To me, it's no dissimilar than getting a taste of something at Costco, right? I mean, you try it, and then hopefully if you like it, you become a customer for life, and there was a cost associated with that sample.
So the capital raised by these companies, in part, went to making rides more affordable and making sure drivers were happy with their compensation. But now that Lyft and Uber are public companies, they have to worry more about making a profit.
You can't compete as a regular business with a startup that is basically paying dollars for dimes. And so a lot of these competitors have gone out of the market now, and so there isn't really a lot of choice left. You have to pay the increased fees or just give up on the service altogether.
And some investors are anxious to hear what solutions Uber and Lyft come up with.
I mean, it's a key part of the business, right? This is a platform that relies on connecting drivers with riders, so there is no business if there isn't any drivers.
What's interesting is there does seem to be a little bit of a battle between the two companies, and so you can get into a geography and turn on your Uber app and not see any cars, and then turn on Lyft and see a ton of cars, and vice versa. So I think there is still this very competitive and liquid market for these drivers that over time should normalize.
Uber declined to comment for this story, but did provide CNBC with some of the information in this story. And Lyft said, "We've added thousands of drivers to the platform and expect rider wait times and prices to improve moving forward." Both Uber and Lyft know how important drivers are to their businesses.
We're increasing incentives for drivers to get back out on the road. Drivers are therefore earning more per hour than typically. Some markets, they're at all-time highs between $35 and $40 in top markets.
The question is, will they be able to make amends with the driver community who, even before the pandemic, were disgruntled with the companies and convince them to come back?
Over time, we'll see some of that balance out, where I think, you're going to see drivers that are going to do combinations of things. They might do rideshare, they might do food, they might do package delivery. There are ways that I think the rideshare companies have figured out that putting more volume through the network, right, having different types of volume, right, and particularly packages, can help better optimize kind of the economics for both the driver as well as for the rideshare company.
There's so many help wanted signs, and yet there's this tremendous mismatch between what the help wanted and what people want to do. And to get drivers, they're going to have to pay more.